So you want to own a luxury resort. You walk into a 5-star property in the Caribbean or Bali or Aspen. The suites are immaculate. The views are stunning. The service is impeccable. Every guest interaction is choreographed to perfection. You see the nightly rates. $800 to $1,500 per night for a standard room. $2,500 to $5,000 per night for a suite. A 200-room property averaging 75% occupancy at $1,200 per night generates $65.7 million in annual revenue. That's just room revenue. Add restaurants. Add spa services. Add activities. Add alcohol. A luxury resort generating $100 million in annual revenue seems feasible. The margins look extraordinary. You're not making anything. You're renting rooms that already exist. The infrastructure is built. The staff is hired. You're essentially collecting money from customers who have nowhere else to stay. It sounds almost too clean. Too obvious. Like owning a printing press that prints money on a seasonal schedule. It sounds like owning a resort in 2005 when international travel was booming, the ultra-wealthy were expanding faster than supply, and anyone with capital and a beautiful location was making money hand over fist. That is exactly the comparison people are making right now. The global luxury hospitality market is worth over $500 billion annually. There are over 7,000 luxury hotels and resorts worldwide. High net worth individuals are traveling more than ever. Corporate retreats are expanding. Wedding destinations are booming. Destination experiences are commanding premium pricing. A luxury resort in a desirable location seems like it should be an ATM that just needs someone to manage operations. But here's what is actually happening on the ground, inside luxury resort operations when the cameras are off and the actual financial statements are open. The reality of owning a luxury resort is completely different from what the headline numbers suggest. Some resort owners are genuinely making money. Many are barely breaking even. And a significant number are losing substantial amounts annually while watching their capital depreciate. The gap between the three groups comes down to a handful of things that almost nobody explains before you spend $50 million to $500 million acquiring and operating a luxury resort. By the end of this, you will know exactly where the money comes from, where it disappears to, what the hidden costs really are, and what separates the resorts that generate genuine returns from the ones that are capital traps disguised as hospitality businesses. What a luxury resort actually sells. The illusion of simplicity. People assume that owning a luxury resort means you're selling hotel rooms. You are. But that's not where the profit comes from. If you're selling hotel rooms at standard luxury rates, the margins are deceivingly thin given the operational complexity. A room generating $1,200 per night seems incredibly profitable until you subtract the costs. What a luxury resort actually sells is experience, fantasy, and the validation that comes from staying somewhere exclusive. The guest isn't paying for the thread count of the sheets. The guest is paying for the story they'll tell when they return home. We stayed at this incredible resort in the Maldives. This is crucial. The luxury resort that succeeds is the one that creates experiences that guests feel obligated to photograph, share, and discuss for months after departure. The sunrise yoga session on the beach. The private dinner on the cliff. The personal butler service. The custom itinerary created for each guest. These are what justify $2,000 per night pricing. They're also what create unlimited operational complexity and cost. But here's where the economics turn brutal. Creating bespoke experiences at scale is impossible. You can create a perfect experience for 20 guests. You cannot replicate that perfection for 200 guests simultaneously. Some guests will have magical experiences. Some will have mediocre experiences. Some will have disappointing experiences. And the mediocre and disappointing guests will write negative reviews that destroy your reputation more effectively than positive reviews build it. A luxury resort lives and dies by ratings and reviews. One bad experience, posted online, reaches thousands of potential customers. The operational challenge of delivering premium experience consistently across hundreds of guests, with dozens of staff members, across multiple service touchpoints, is exponentially harder than people imagine. The full upfront investment, what actually costs money. Everyone talks about the real estate cost. Nobody talks about everything else that eats capital before you open the doors to the first guest. Land and property acquisition, $20 million to $200 million. A luxury resort needs a pristine location. Beachfront in a desirable destination. Mountain views. Unique geography. Locations. This valuable command premium pricing. A 20-acre beachfront property in the Caribbean costs $50 million to $150 million. A mountain property in Aspen or the Alps costs $30 million to $100 million. A tropical property in Bali costs $15 million to $50 million. Location is the largest capital expenditure, and it appreciates or depreciates based on market forces completely outside your control. Construction and development. $30 million to $300 million. Building a luxury resort from scratch requires architectural vision, premium materials, and meticulous construction. A 100-room luxury resort costs $300,000 to $800,000 per room to construct. That's $30 million to $80 million in construction alone. A 200-room resort is $60 million to $160 million. Premium finishes, smart home systems, and customization add cost. A resort with restaurants, spa, conference facilities, and multiple pools requires additional $20 million to $50 million in ancillary construction. Pre-opening operations, $10 million to $50 million. Hiring and training staff. Marketing and brand building. Obtaining permits and certifications. Furnishing and equipping rooms with luxury linens, furniture, and amenities. Stocking wine cellars. Installing technology systems. Establishing supplier relationships. A luxury resort requires 200 to 500 employees depending on size. Hiring, training, and payroll during the pre-opening period is $5 million to $15 million. Technology and systems, $5 million to $20 million. Property management system. Booking platform. Wi-Fi and connectivity infrastructure. Smart room systems. Security and surveillance. Guest communication systems. Integration with third-party platforms. Luxury resorts require sophisticated technology that costs millions to implement. Licensing, permits, and legal, $2 million to $10 million. Hotel licensing. Health permits. Environmental permits. Building permits. Legal structure and compliance. Insurance documentation. International properties require additional complexity and cost. Working capital and operating buffer, $20 million to $100 million. Money to cover operating expenses, staffing, maintenance, and contingencies for the first 12 to 24 months while you're ramping occupancy and establishing operations. The real total investment. For a mid-sized luxury resort with 100 to 150 rooms, the total capital investment ranges from $150 million to $500 million depending on location, architecture, and amenities. A 200-room resort is $300 million to $1 billion. This is why most luxury resorts are owned by large hospitality companies or mega-wealthy individuals. The capital requirements are enormous. Most resorts are financed. A $300 million investment financed at 4% over 20 years is $18 million per year in debt service. Some resorts are built with equity from founders or private equity. Some are built as development projects where the developer hopes to sell after opening to a larger operator. The financing structure dramatically impacts the economics. Where the money actually goes, the operating cost reality. Once you're open and operating, the costs don't pause. They accelerate. And this is where the luxury resort business reveals why margins are so much thinner than the headline revenue numbers suggest. Labor, 35% to 55% of revenue, realistically 40% to 60% in most luxury resorts. This is where luxury resorts get destroyed. Labor is the largest operating expense. A 150-room luxury resort needs roughly 300 to 500 employees depending on service model. Housekeeping, food service, maintenance, security, concierge, management. In developed countries, average hospitality wages are $40,000 to $80,000 per year per employee. A resort with 400 employees at average $50,000 per employee is $20 million annually in base wages. Add benefits, payroll taxes, training, and management overhead, and labor costs reaches $25 million to $30 million. On a resort generating $80 million in revenue, labor is 31% to 38%. But luxury resorts typically generate lower revenue per employee than budget properties because service ratios are higher. A luxury resort might generate only $200,000 per employee in revenue. A budget resort generates $400,000 per employee. That means a luxury resort's labor percentage is actually 40% to 50% of revenue for comparable staffing. Food and beverage. 25% to 35% of revenue. Luxury resorts typically include at least one meal with the room rate, plus restaurants and bars. Food costs are premium. Imported wines, fresh seafood, organic produce, labor-intensive food preparation. The cost of goods sold on food service is higher in luxury properties than budget properties. Food and beverage revenue is high, but food cost percentage is also high. Net F&B margin after food costs and labor is often 15% to 25% of F&B revenue, which might be 20% to 30% of total resort revenue. Net F&B profit, 3% to 7% of total revenue. Housekeeping and maintenance, 10% to 15% of revenue. Luxury rooms require more maintenance. Linens, towels, and amenities must be premium. Turnover between guests requires deep cleaning, not quick turnovers. HVAC systems in tropical climates work harder and break more frequently. Pool maintenance, landscaping, building maintenance. A luxury resort might employ 80 to 120 housekeeping and maintenance staff for 150 rooms. Cost, $5 million to $8 million annually for a mid-sized resort. Utilities, 4% to 8% of revenue. Air conditioning in tropical climates is expensive. Hot water systems, multiple pools, kitchens operating continuously. Wi-Fi infrastructure. A luxury resort with 150 rooms and multiple restaurants operates 24/7. Utilities are a major expense. Cost, $3 million to $6 million annually. Marketing and sales, 5% to 12% of revenue. Building brand awareness for a luxury resort requires substantial marketing. Online advertising, travel agent relationships, public relations, social media management, event sponsorships. A luxury resort needs to maintain 60% to 70% occupancy year-round. Getting there requires active marketing. Cost, $4 million to $10 million annually. Administrative and management, 8% to 12% of revenue. Management staff, accounting, human resources, legal, compliance. Cost, $6 million to $10 million annually. Insurance, 2% to 4% of revenue. Property insurance, liability insurance, workers' compensation. Cost, $1.5 million to $3 million annually. Royalties and franchise fees, 3% to 6% of revenue. If applicable, many resorts operate under franchise agreements with major hospitality brands. Marriott, Four Seasons, Rosewood. The franchise takes 3% to 6% of revenue plus additional marketing fees. Cost, $2.4 million to $4.8 million annually on an $80 million revenue resort. The monthly revenue and cost reality for a typical luxury resort. A 150-room luxury resort averaging $1,200 nightly rate, 65% occupancy, monthly room revenue, 150 rooms times 30 days times $1,200 times 65% equals $3.51 million additional revenue from F&B, spa, activities. Other, $1.5 million total monthly revenue, $5 million now the costs. Labor, 45% of revenue $2,250,000 food and beverage costs, 15% $750,000 housekeeping/maintenance, 10% $500,000 utilities, 6% $300,000 marketing/sales, 8% $400,000 administrative, 10% $500,000 insurance, 3% $150,000 franchise fees, 4% $200,000 miscellaneous/reserves, 5% $250,000 total operating costs, $5,300,000. Operating loss, $300,000, annual operating loss, $3.6 million, plus debt service, $18 million/year, $1.5 million per month, total monthly loss, $1.8 million, annual total loss, $21.6 million. This luxury resort with 150 rooms, generating $60 million in annual revenue, is losing $21.6 million annually. The model is structurally unprofitable. What resort owners don't account for, the utilization trap. The math above assumes 65% occupancy. In reality, utilization varies enormously. Seasonal fluctuation: peak seasons might see 85% to 95% occupancy. Off-seasons might see 30% to 40%. A beach resort in the Caribbean is packed in February. It's empty in September. You can't adjust labor, utilities, or rent downward in off-season. You're still paying $500,000 per month for utilities and $2 million per month for labor, even if occupancy drops from 65% to 40%. You're now losing $4 million to $5 million monthly during off-season. Rate compression: during peak season, you charge rack rates of $1,500 to $2,000 per night. During off-season, you discount 40% to 60%. Your average rate drops from $1,200 to $600. Revenue per occupied room plummets. You're discounting to fill rooms, but at lower rates, occupancy cost per room is higher and margin is lower. Demand destruction: a natural disaster, pandemic, or recession destroys demand. Occupancy drops from 65% to 30%. Revenue collapses. But your expenses remain the same. You're losing millions monthly for an extended period. Brand competition: a new luxury resort opens nearby at a lower price point. Your occupancy drops from 65% to 50%. You have to discount to compete. Margin shrinks. Service quality and reputation: a luxury resort's value is entirely dependent on guest satisfaction and reputation. One bad review on TripAdvisor reaches thousands. One guest's negative social media post can damage reputation permanently. Delivering luxury experiences consistently across 150 rooms with 400 staff members is operationally impossible at some threshold. Some guests will be disappointed. Some service failures are inevitable. As soon as reputation suffers, occupancy drops and you can't raise rates. Revenue collapses. The best resorts invest obsessively in staff training, quality control, and guest experience management. This costs additional millions annually. The resorts that cut corners on staff training or service quality see reputation erosion and occupancy decline. The brutal mathematics of leverage: here's what makes resort economics so brutal. A $300 million resort with $18 million annual debt service needs $60 million in annual operating profit just to break even. That requires operating margins of 50% on $120 million revenue. Industry average operating margins are 10% to 25%. Most resorts need 30% to 40% operating margins just to service debt and pay distributions. This is why most luxury resorts are financed with investor capital, expecting equity returns, not debt service from operations. A resort financed with $200 million debt and $100 million equity needs to generate 15% annual returns on equity to satisfy investors. That's $15 million per year after paying $12 million in debt service. That requires $27 million in annual operating profit. On $80 million revenue, that's 33.75% operating margin. Most resorts don't achieve this. The good scenario: when luxury resorts work, you acquire an existing established luxury resort with a strong reputation during a market downturn. Purchase price: $120 million, 60% discount to replacement cost. You refinance at favorable rates. Debt service: $8 million annually. The property is already operating at 70% occupancy with $80 million revenue. Operating costs are $60 million. Net operating profit: $20 million annually. After debt service, $12 million. If you finance with $80 million debt and $40 million equity, you're generating 30% annual returns on equity. You own a profitable asset. Alternatively, you own an ultra-luxury resort in an exceptional location, Bora Bora, Maldives, Aspen, where you can command premium rates of $2,500 to $4,000 per night and maintain 75% to 80% occupancy year-round. Your revenue is $150 million to $200 million annually. With disciplined cost management, you generate $35 million to $50 million in operating profit. Now the resort can service debt and generate genuine returns. The bad scenario: the more common outcome, you develop a luxury resort from scratch in a secondary destination. Total investment, $250 million. You finance $200 million. Debt service, $12 million annually. Opening occupancy is 45% because the destination lacks brand recognition and visitor volume. Revenue is $36 million. Operating costs are $32 million, high percentage of revenue because fixed costs are spread across lower occupancy. Operating profit, $4 million. After debt service, losing $8 million annually. You're underwater from day one. You spend 3 years trying to build brand and occupancy. Occupancy improves to 55%. Revenue reaches $44 million. Operating profit, $8 million. Still losing $4 million after debt service. You're trapped. You can't generate enough profit to service debt. You can't sell at a reasonable price because buyers see the same unprofitable outlook. You're locked in a $200 million loss position with no exit. The hidden advantage of brand and scale: this is where the economics get interesting. A Marriott, Four Seasons, or Rosewood resort owned by the brand has advantages independent operators don't have. Global brand recognition drives occupancy. Booking systems with millions of registered travelers. Loyalty programs that incentivize direct bookings. The brand can command premium rates that independent operators can't. A Four Seasons can maintain 75% plus occupancy year-round across diverse properties. An independent resort in a secondary destination struggles to maintain 50%. This is why independent luxury resorts are increasingly becoming franchises or management contracts. The owner provides capital and land. The hospitality brand provides operations, marketing, and brand. Revenue sharing occurs, but the brand captures significant margin because they control the revenue-generating operations. Conclusion: the actual economics of luxury resort ownership. Owning a luxury resort is not a passive income business. It's an extraordinarily complex operational business requiring flawless execution across hundreds of staff members and thousands of daily guest interactions. One negative review can impact occupancy. One service failure can damage reputation. One seasonal decline can eliminate annual profits. The money in luxury resorts goes to 4 groups. First, the hospitality brands capturing 3% to 6% of revenue plus marketing fees. Second, resort staff capturing 40% to 60% of revenue in labor costs. Third, the resort operator capturing operating margins if occupancy, rates, and costs are optimized. Fourth, the property owner capturing land appreciation if location remains valuable. The separation between resorts that generate genuine returns and those that destroy capital comes down to pre-acquisition decisions that most owners don't understand. Location selection in proven high-demand destinations. Acquisition pricing during market downturns at deep discounts. Operating cost discipline that maintains service quality without excess spending. Occupancy management that balances rate optimization with volume. Brand partnership or franchise that provides operational leverage. A luxury resort that operates at 75% occupancy in an exceptional location with strong brand can generate substantial returns. A luxury resort that operates at 50% occupancy in a secondary location with no brand recognition will lose millions annually. The difference isn't the resort concept. It's location selection, brand strength, and operational execution. Here's what almost nobody discusses openly. The luxury resort business is fundamentally a destination play. You're not building a resort and hoping people discover it. You're acquiring a location where people already want to go, then operating the resort well. Trying to build a destination in a place where people don't naturally travel is fighting geography and human behavior. It's nearly impossible to overcome. The resort owner who buys an established property in Bali, Bora Bora, or Aspen, places where people already travel, can generate returns. The resort owner who develops a property in a secondary location hoping to attract visitors will likely lose everything. And the $250 million capital commitment makes this one of the highest stakes, lowest margin capital deployment decisions you can make in hospitality.